And welcome to Investing with IBD, sponsored by Scoofus Capital Management. It's April 27th, 2022. It's a Wednesday afternoon, and I'm Justin Nielsen, your host. And normally I would have Arusha Pires along with me, but he's out this week, so he's going to be taking a little bit of a break. But I have a special guest to replace him. That is David Saito-Chung. He is known as our Hatman in Chief. He's got a lot of roles, actually. So the official title is Deputy Markets Editor at Investors Business Daily, and as well as being a long-term colleague, he's also, let's think about this. He helps manage the leaderboard model portfolio, curates the Investors Corner articles, was an author of Investors Business Daily, Making of Millionaires, plays chess, Harvard man, golf aficionado, whiskey, wine. What am I missing here? Frequent host and panelist on the Ibd Live show. So this is why, he wears a lot of hats. This is why we call him the Hat Man in Chief. So welcome to the show, David.
Justin, I haven't heard that positive a introduction in a long while. So hats off to you, my friend.
Okay, and hats off from the Hat Man. Okay, perfect. So now, in addition to all of that I just mentioned that David has done, one of the things he did back when we had our master's program, we had one of our more popular sections was led by David, a presentation that he did called Investing with Conviction. So we're going to turn that on its head a little bit and kind of go on the other side when it's time to maybe not have conviction and to, really think defense. So that's what we're going to cover in our learning segment. And of course, David got some watch list names that he's going to share with us. But first, let's go ahead and talk about the market right now, the current market. So how about if we start with the S&P 500, David, and I'll go ahead and just try and get your take real quick.
Absolutely. Well, since Friday or April 22nd, IBD did change the outlook to the worst level, the market in correction for the third time already this year in 2022. And so given what happened today on Wednesday, it's really not surprising to see the S&P 500 trading roughly almost 15% off its all-time highs. That qualifies as an intermediate correction for sure, doesn't it, Justin?
Oh, absolutely. And, I should mention just a little behind the scenes. I mean, we were really close to going to that market in correction on Thursday. That was a pretty rough day. The NASDAQ had undercut its lows. If we just go over there real quick, I'll kind of show what the NASDAQ looked like. The NASDAQ undercut its lows from the previous couple weeks, that whole area. But the reason why we didn't was because the S&P 500 was holding right above those lows. So that was kind of making it a little bit, okay, do we go to correction or not? Because the S&P 500 was certainly the leading index.
Without question, we've continued to see this amazing recovery by the cyclicals, namely metals and oil and gas, and to some extent financial stocks as well. That would include insurance, not just the banks. So it really makes the point here that you have to look at multiple indexes. We've been watching the Russell 2000, obviously the NASDAQ 100, and those indexes are not only in a correction, they're in bear market territory, with the NASDAQ failing to really make a big move today on Wednesday after that nearly 4% throttling, if you will. We are still now 24% off the peak of 16,212 on the NASDAQ. So in this kind of situation, defense is really key, and that's something we're going to talk about during the show.
Now, one of the things that was really kind of interesting is it seemed like it was definitely a bifurcated market, right? You had, as ugly as the indexes looked, you had this whole other area of strength. As you mentioned, the cyclicals, whether it was the energy stocks. Here's XLE, the Energy Selects Sector Spider Fund. That was, even with the rout last week, it's still right there at its 50-day moving average line. You had a lot of the materials. Maybe if we just look at XME, the metals and mining, that was looking so strong, but man, it was like they just pulled the rug out right from under you with all of these stocks that were holding up well. having some drops of 10% in a day. So when you kind of think that you're in the right stuff, and then all of a sudden it's, those aren't working. Does that kind of change your thinking?
Absolutely. You don't really necessarily look for a reason for why these stocks fall 5, 10% or more in a single day. Sometimes it's very obvious, right, Justin? It's earnings.
Mhm.
Sometimes it's some big piece of news that is
Right.
really blanketing the industry. But in this situation, it's really what the market tends to do, rising in an escalator-like fashion, and then sometimes falling like an elevator. The good news here is that with these energy metals plays, they haven't taken an elevator all the way back to the ground floor.
Yeah. Yeah. They went, maybe halfway down. And
Right,
certainly one of
right.
the things that was rough is, and this can be frustrating, is you see weeks or even months of progress just dissipate in a matter of hours, sometimes. And so as an investor, what can you take away from that in terms of, uh, should you have done, I mean, it's obvious you start thinking of what should I have done differently. If you're holding
Mhm.
on to them and you took that whole ride down, you start thinking, okay, should I have sold into strength? Should I have, had a trailing stop? What kind of things do you use? What kind of strategies do you use in order to make sure you're not kind of caught off guard?
Well, Justin, in my 20 plus years of working for IBD and learning how to invest in the cancel method, I've really learned that rules take precedence over emotion. So when you are up 20 to 25% in a stock or ETF over a short period of time, you often want to feel like you want to wait for that extra 20, another 20 to 25% gain, right?
Yeah.
Whereas our rules really teach all investors to take profits in most of our companies, most of those stocks at that 20 to 25% range, which allows you to be wrong in other stocks. So long as you cut your losses at 7 to 8%, you're maintaining a 3 to 1 win loss ratio. It's tough to do with that emotion of greed and hope driving you to hold that stock longer. But the recent action really proves again that the M in CanSlim, the market, really is the most important factor. So this year has been challenging even for those cyclical stocks. They've been
Mhm.
running up since the fourth quarter of 2020. And on IBD Live, a number of panelists have said that we're kind of in the middle to late innings in these stocks. So that means more volatility, perhaps less upside in the near term, more potential for these kind of corrections. So, in sum, we do want to try as best to defy our emotion by selling most of our companies, or at least a portion of those stocks, at that 20 to 25% profit potential. And then the trailing stop idea is good too, because if it doesn't reach that profit level but starts to come down fast, like these elevator declines, salvage as much of the gains you can before you see them all completely dissipate.
Right. And that's where moving average lines can really come into play, because they almost act as a little bit of a trailing stop for you. The more progress you make, the more those moving average lines are going to rise. And just kind of naturally, if you're using that as a stop, they're going to kind of naturally put that stop higher and higher as the price goes up. But certainly you have to be careful of, and this is something we talk a lot about on leaderboard, when things get very extended from their moving average lines. It's almost
Hmm.
more important to think about taking some of those profits, because that's where you kind of almost expect a little bit of a reversion to the mean.
Totally. And back to your point, Justin, about the moving averages, there's a good reason why we paint that 50-day moving average in red. It's
Hmm.
a very important technical
Right.
level to look at.
Yeah, yeah.
And more recently, and so that goes across the board in all of our products. The charts on ibinvestors.com, Marcus Smith's swing trader or leaderboard. And then more recently, because the market tends to move a little more quickly than say 60 years ago, we see that 21-day exponential moving average, the line
Mhm.
that's usually drawn in green, as another important level to watch to help you lock in at least some gains if you don't happen to get the very, very top, which is
Mhm.
extremely hard to do anyway.
Now, one last thing before we kind of move on to our next segment, I just want to kind of revisit the S&P 500 because our guest last week was Eric Krull, and we were talking about how the S&P 500 hadn't quite gotten down to where it had undercut or closed below the follow-through day of March 16th. So here we have the March 16th follow-through day that I'm kind of noting in red there for our viewers that are watching this on video. And certainly we didn't get there Friday, but Monday we undercut. Intraday didn't close below it. Tuesday we did close below that follow through day, and that usually does kind of sign a death knell for the index. Kind of ends a rally a lot of times. You're usually going to see the low get challenged. Now in this case, we did undercut the March lows, but that February 24th low still remains intact for the S&P 500. So we'll see. But one of the things that's been kind of tricky, I mean, we had a strong reversal on Monday, and that might have been enough to make some people think, hey, is it over? Is it time for me to get back in? Is there anything that you can kind of say to allow for people to consider the other side of things about being patient, or when is it truly oversold and time to think about going in heavy, even if it's in an index ETF?
That's a very big question and a very important question, Justin. And it involves looking not only at the S&P, but also the action of the NASDAQ, the action of various leading stocks. And right now, we are not seeing many fresh new bases and fresh breakouts from early stage bases, which would give me a lot more confidence that, yes, we've turned the corner in terms of this correction. Two, we've talked a lot on Ibd Live, for instance, and the Stock Market Today videos about the growing bearishness among various psychological indicators. And while that's positive, in a sense that at some point we'll see total exasperation and desperation among sellers, that usually points to a possible market bottom. But in my mind, I don't think we're seeing extreme bearishness yet. So that's something that I like to watch. Finally, the follow through day. Well, we're looking for a new one, and it is very disappointing, I would say, for many listeners of your podcast, that for a while it looked like that March 16th follow through was going to work, because it actually survived 2 weeks without a distribution day. In other words, a pronounced heavy selling day by institutions, decline of 0.2% or more in the S&P or the NASDAQ, in higher volume than the prior day. The first distribution day that cropped up, Justin, happened to be, according to my notes, on March 31st. It was a 1.6% drop. Good markets can handle 1 or 2, but then over the next 2 weeks, we amassed 5 more distribution days. So that was a really important bearish signal, just as the S&P 500 was struggling to hold those key moving averages itself.
Yeah. And one of the things that I think has been a little bit tricky about this market is even when the indexes have been showing strength, a lot of times when you look under the surface, okay, what's driving the strength? And it's a lot of this bottom fishing, a lot of the stocks that are below their 200-day moving average lines. And it's like, okay, well, what am I going to do with that? I'm not going to be buying, a Netflix that's, off 70% from its high. So it gets a little tricky. But when we come back, we'll talk a little bit more about when it's time to start thinking more defense rather than holding on to some of these big winners. And David's going to share with us a potential precedent with the Don't Fight the Fed theme. So stay tuned. We'll be right back. Peter Skoufis, founder of Skoufis Capital, has successfully managed money using Bill O'Neill's strategy for the last 17 years. Peter's missed major market crashes, such as the financial crisis of 2008 and most recently the coronavirus crash of 2020. One of his strengths is finding new leadership in new market uptrends. If you would like to talk to Peter and get his thoughts on the current market and what to do now, or get a complimentary review of your portfolio, feel free to contact him at skoufiscapital.com. That's SKOUFIS Capital, CAPITAL.com. And fill out the contact form or by calling 866-562-2634. Protect your capital and don't miss the next market uptrend. Okay, welcome back to the Investing with IBD podcast, sponsored by Skoufis Capital Management. It's Justin Nielsen here, along with my guest, David Saito-Chung, Deputy Markets Editor, Hatman-in-Chief, and all-around general nice guy. So, David, you came up with a really interesting precedent to talk about, and that's the 1994-95. What was it about 94-95 that kind of made you think, hey, this is something worth taking a look at?
Well, thank you, Justin. I'm really glad that we have a chance to talk about this one in depth. And while it wasn't a very deep correction from off the highs when the major indexes peaked in 94, what really drew me and hopefully you as well to studying this period of time was a lot of parallels between what happened then in terms of monetary policy, macroeconomic events, and what's going on today.
Mm-hmm. Good point. So let's go ahead and start with the S&P 500, and we'll take a look at that. And I've just put my change date feature on MarketSmith back to 1996, just kind of went right back to April of 1996. I'm looking at a weekly chart, and you can see that, I mean, just a really powerful move that happened in 95. I'm showing that. But what we're going to be really paying attention to is this time period in 94, 95, where the index really didn't move that much. It just couldn't seem to make much progress. And this was, keep in mind, in the go-go 90s.
Exactly. And so specifically, Justin, the S&P 500 corrected just merely 10% off its peak way back then in 482. The NASDAQ fell a little bit more, about 15%, 14 to 15%, but it was a long drawn out correction. And there were lots of things going on. Let me just highlight a few. One was you had the Federal Reserve concerned about inflation and other issues, raising.
Sounds familiar.
There you go. Raising interest rates 7 times over a period of just 1 year, from February 1994 to February 1995, 300 basis points in total. And just like we talked about during the break, initially they started out with several 25 basis point or quarter point hikes in the Fed funds rate. Then they accelerated. In fact, one of those rate hikes was a 75 basis point hike, and eventually topped off with a 50 basis point hike, sending the Fed funds rate to 6% in February 1995. Now, also at the same time,
3%.
Yes,
so
from 3%.
300 basis points, yeah.
300 basis points, doubling, right?
Mm-hmm.
So either way you cut it, a significant change in monetary policy. At the same time, what's interesting back then was, well, we were in the middle of a tragic war happening in the former Yugoslavia. That started from April 92 until the end of 1995, when leaders of Bosnia, Croatia, and Serbia signed the Dayton Accords in Dayton, Ohio. At the time, too, there was concern about the possibility of heavy federal spending in the U.S. government. Then President Clinton had announced his plan for a universal health care plan. That was in September 1993. He also took measures to punish Japan amid a trade war going on between these two superpowers, economic superpowers. That happened in March of 94. In October 94, the Russian ruble plummeted 21% in 1 day versus the US dollar.
Wow.
The only difference between that time and now, in terms of other markets, was crude oil actually was suffering a deep decline. And in March 28, 1994, it had hit a 5-year low. So just like Mark Twain said, Justin, right? History doesn't repeat itself. It often rhymes, but I still think this is a useful time to look at, because we can also look at this period of time through the lens of various big market winners at the time and how they fared.
Yeah. So maybe we can just start by taking a look, because you did mention the NASDAQ had a little bit more of a correction. It went from a peak of 804 down to 690, and that was just in a few months. Now, what was interesting, just, before we get to the stocks, it seemed like there was a kind of a sharp move down. And while a low might have been made, um, it that low held for quite a while, but it really didn't make much progress for a while. So it's
Absolutely.
not, it's not that the low, you had multiple waves down where things were getting lower and lower. You kind of had the low, but then it was hard to make progress, it seemed like.
For sure. I remember, and I'm sure William O'Neill, who founded IBD, probably put this in your ear too, Justin, is that typically in a normal bull and bear market cycle, bear markets can last anywhere between 9 and 12 months
Mhm.
after a 3 to 4 year bull market cycle. And in the case of the S&P and the NASDAQ, certainly it didn't meet that textbook definition of a 20% decline or more, but it was a long period of time, just like you mentioned.
Mhm. Yeah. So now, again, you were kind of known for your investing with conviction presentation, and let's talk a little bit about some of the individual stocks. So when you've got a correction happening, and again, it doesn't have to necessarily be deep, but the stocks you have to expect, especially the growth stocks, you
Right.
have to expect that they're going to correct a lot more than the indexes. So how do you handle some of these big winners? And I mean, we're talking about some of the behemoths of the time, like Cisco, which we were
Hmm.
talking about on IBD Live this morning, and you mentioned how it had a 75,000% move from its 1991, double bottom from an IPO base to its top in March of 2000.
Right.
So,
Right.
with stocks like this that had such a phenomenal move, what do you do with them during a period like this when they're just looking like they could be done?
Such a great question. And one thing that I've learned about the true market winners is that in a normal correction, expect your winning stocks or the leaders in the market to fall 1.5 to 2.5 times the decline in the major indexes. So if we're down 10% in the S&P or the Nasdaq, it's perfectly acceptable to see a leading stock fall up to 25%, maybe
Hmm.
even 30%. However, Cisco, CSCO ticker symbol back then when it peaked after a long run up, just like you talked about, Justin, actually fell 54% off its peak back in 94. And it actually deserved the time to rest and digest those gains. From that, I believe it was actually October 1990, just a little bit before
Yeah, that's
1991.
right.
But
Hmm.
that's when we had that double bottom breakout,
Hmm.
signature double bottom base, beautiful move, excellent fundamentals at the time. The fundamentals of Cisco didn't change very much. However, it just had a gigantic move, so it needed time to digest that. And among the very few handfuls of super winners, when you've gone up triple, quadruple, quintuple, you've earned the right to correct as much as 40 to 50%, but it's very difficult to hold through that. You can always wait for the stock to repair itself, set up a new base, and then get back into that stock, uh, which allows you to not have to sit through the agony of a 50% correction. I mean, that's a lost capital, and obviously back then there was no guarantee that Cisco was going to come back. Fortunately for shareholders, they benefited from an outstanding management team, continued execution. They pivoted in their strategy to become more acquisitive uh, in the mid 90s, as opposed to being just the outright disruptor, innovator in how we handle and process and look at information through the internet. Uh, so 54% actually sounds, yeah, pretty huge correction, but it wasn't alone. Amgen was another example of a big long-term winner. It fell 60% during this 94 to 95 market correction. So that's well more than 2.5 times the normal correction you would see. I also want to highlight, well, Amgen went on to actually survive that 60% drop, Justin, and broke out with the rest of the market, rose 20-fold because it's just such a special company. Pfizer fell 40%. Microsoft was actually the best among that small bunch of stocks. It had formed a base-on-base pattern, and in that first base in 93, it was a 28% drop from high to low. And then in 1994, as the market was cooling off, trying to regain its footing amid all of these different things going on in the world, it fell only 13% in the second part of that base on base. So as we go forward to 2022, what we want to do is look for those companies that are able to fall roughly the same amount as the NASDAQ and S&P 500, form good patterns in which they show less of a decline, because that literally means that they probably have a lot of relative strength ready to go, shooting out to new highs and giving all of us a chance to make some fast gains at the right time.
Yeah, absolutely. And one thing I just want to mention, because I don't want people to get the sense, we had Cisco up before, and we were talking about that huge rise. I actually, in order to get the chart to fit on our screen, I had to change the scale to show, because it had a split adjusted price that it was coming out of below $1, and of course it was not below $1 at that time in 1990, that double bottom that you mentioned. It was, there were a
25.
lot of splits. Yeah, a lot of splits here along the way. Yeah, I think, yeah, 25, 30 bucks was or 27, if I recall, was the double bottom buy point.
Exactly.
Or shakeout plus 3 actually was another potential entry on that one, because there was a gap up that would have been tough to handle, because it had one of those pullbacks that 8%. Anyway, just so people know. Now, one of the things too, since we're talking about Cisco, let's just real quickly look, because I like the idea of what you're saying. Rather than hold on to a stock through a 50% correction, and again, as you said, it certainly deserved it. I mean, going below 1, split adjusted, to 20, that's a huge move. So correcting down to 10, yeah, that's still a move from 1 to 10. That's not bad. But when you have a stock that has such a outsized correction, 50%, usually those are stocks that we avoid. What clues might have you seen on Cisco and some of these leaders that had these massive corrections, but were still worth another look when the market turned around?
Well, I would say back then, just like what we would do now, is to make sure you keep an eye on some key ratings that IBD furnishes, whether it's an EPS rating. Would like to continue to see the EPS rating, as well as the SMR grade. That stands for sales, profit margins, and return on equity, to stay strong. When you fall 50%, you're definitely going to get a hit to the relative strength rating, because that's a 12-month based price performance gauge. I wouldn't be surprised if at the bottom of that correction, Justin, that Cisco's RS rating fell into the 60s or 50s even. Maybe even more, because the market didn't fall as much over a trailing 12-month period. But in my study of big winners like Cisco and Amgen, they might have had a quarter or two of a mild deceleration in earnings per share growth, which means a lower year-over-year increase percentage-wise in the earnings in the most recent quarter compared to 2 quarters ago. But then they immediately revved up their growth again and maintained their leadership as a fundamental company. They continued to innovate. They introduced new products, new services that caught fire. That's the end in canceling. And finally, they showed evidence of institutional accumulation. So that's where using our database to see whether the number of funds are still buying the stock, are we seeing a steady increase in the number of funds that own it, as well as signs on the chart, though, especially the weekly chart, where are you seeing reversals off lows in heavy volume? Are you starting to see volume dry up on the weekly declines and volume start to pick up on the upswing? Those little clues will tell you in real time, rather than waiting for that SEC filing, that institutions are accumulating shares from weaker shareholders.
Yeah. One other thing I would add, in looking at the Cisco chart, and this just seems to be something that I like to see. If you see something that goes down considerably, like one of those 50% bases, those do tend to not work as well. But the ones that do work, what I find is a lot of times you have this tight action. So if we look at the chart and you just kind of see in this, after this big move down, after this big chart consolidation, you have this area right in here where you had kind of this little cup, only a 14% decline. So now you had kind of your tighter action,
Yes,
and that does seem
great
to be
point.
something. But I guess to kind of wrap a bow on this topic, you talked a lot about the fundamentals and stuff, and that is certainly a part of having the conviction in a stock. But what about the idea that a lot of times the fundamentals look so great at the top? So what do you do when the fundamentals look great, but something is going on the technical side?
That is a very important point to make again, Justin, because one, yeah, that happens a lot. Everything looks great at the top. That's one of Chris Gessel's favorite sayings, our chief content officer. And I'll never forget the time when he mentioned that during our discussions of the market in the office. The market is telling you something that's really important for your portfolio. And sometimes stocks will fall hard because the market is now in poor shape, and even the CEOs and the CFOs of those companies have no idea what's going on.
Mm-hmm.
That's what's remarkable about the market. The market knows all, and we have to respect that collective wisdom among so many intelligent, hardworking, bright money managers, particularly money managers out there, and those managing large accounts. Their decision making reflects in the price. So that's why we often say buy on fundamental, technical, and institutional strength, but sell on technical weakness.
Mm-hmm.
You can always get back into a winning stock if it proves that it can be a leader in the next move. And what is it, Justin, that percentage of stocks that have topped but then go on to rally and lead the next bull market cycle is way in the minority?
Yeah, one out of eight, according to a study that Charles Harris and Mike
Yeah.
Webster did years ago for Bill O'Neill. Mm-hmm.
Also, I want to make a last point about the stock market today. We're not saying at all in this podcast that we're expecting a similar outcome to what happened in 1994, 1995. Clearly, for one, we have made a tremendous move from the 2018 end of the 2018 bear market. I believe we were up, let's see, about 162% from in the Nasdaq. The Nasdaq bottomed out in December 2018 to 16,212 in November of 2021. That was a 162% gain in just under 3 years. Meanwhile, going back to the Nasdaq in 1994, before that 14% correction, the Nasdaq had rallied 149% from October 1990 until March of 1994. So similar time frame, similar gains, but keep in mind that we can't really predict the future. We're not going to say yes by the end of this year we're going to have another big rally. And that's why it's so important for everyone to just stick to that day-to-day, the week-to-week observation of the major indexes and leading stocks. That's the true heart and guts of speculation. The word speculation itself literally means to watch. And the more you keep watching, the more likely you're going to be successful in nailing that market bottom going forward.
Great points, David. So when we come back, speaking of watching, we're going to find out what David Saito-Chung is watching for himself. Stay tuned. We'll be right back. Peter Skoufis, founder of Skoufis Capital, has successfully managed money using Bill O'Neill's strategy for the last 17 years. Peter's missed major market crashes, such as the financial crisis of 2008, and most recently, the coronavirus crash of 2020. One of his strengths is finding new leadership in new market uptrends. If you would like to talk to Peter and get his thoughts on the current market and what to do now, or get a complimentary review of your portfolio, feel free to contact him at scoufiscapital.com. That's SKOUFIS Capital, CAPITAL.com. And fill out the contact form or by calling 866 562 2634. Protect your capital and don't miss the next market uptrend. And welcome back to the Investing with IBD podcast, sponsored by Scoufis Capital Management. It's Justin Nielsen here, along with my guest, Hatman-in-Chief, David Saito-Chung, Deputy Markets Editor at Investors Business Daily. And David, how long have you been at Investors Business Daily now?
Well, believe it or not, technically it would be over 4 decades. Not all 4 decades, but
Right.
but I joined the IBD team in January of 1999, catching the tail end
Okay.
of the .com bubble. I was a Tokyo Stock Exchange correspondent working for Kyoto News as a bilingual journalist for about a year. Got my feet real wet in terms of reporting and analyzing the Japanese stock market. That led me to a really strong interest in covering U.S. stocks. So basically, from 1999 until the present, I've always been involved in some shape or form with the markets team.
Yeah. So it's been incredible. I certainly know very early on your Investors Corner articles were something that I caught my attention. That's when I first got the name David in my lexicon. I'm like, this is someone to watch. So let's take a look at some of the stocks. You know what? One other thing I wanted to before we get to stocks, you have a pretty good Twitter following and a lot of great information that you share there. So I wanted people to have that information too. So what's the best way for people to follow you on Twitter?
Well, thanks, Justin. I actually keep 2 Twitter feeds active, and those of you who want mainly business and investing related tweets, then please check me out at IBD_D as in David Chung, at IBD_D Chung. If you want a little more flavor of what I do after 5 p.m., which includes breaking out a bottle of whiskey or sharing what I enjoyed in travels or eating or dining over the weekends, plus additional tweets on the stock market, great stocks to watch, sell signals, the whole 9 yards with Can Slim. The second Twitter handle would be at Saito-Chung, SAITOCHUNG, all one word, at Saito-Chung. So fortunately, a few people do actually follow both, and I'm very gratified. I just like to maintain both of those.
Yeah, and certainly after 5 o'clock doesn't mean it's all whiskey. There's stocks that happen after 5 o'clock too. So let's get right into the stocks, and we'll start with a biotech stock, Alkermes. This is one that we were talking about a little bit on the IBD live show today. The ticker symbol is ALKS. So what is it about this stock that kind of caught your attention?
Well, a couple things, Justin. One is we have seen a few biotech and big pharma names holding their own so far in 2022. Some of them, like Moderna and BioNTech, made tremendous moves in 2020, 2021, but they've made these deep corrections. In the meantime, we've seen some others really step to the foray. And given how this stock just recently caught the entire news team's attention, it's the IBD stock of the day. In fact, today we have a nice article on that. I was impressed by the fact that the stock has made a nice move from 12 back in early 2020 to as high as 30, 33 or so, and now it's made what looks like to be an earlier stage cup with handle.
And it looks like just hovering over. This is one of the things I like to do in MarketSmith. You hover over, and it kind of gives you some stats. It looks like this latest cup with handle is about 28 weeks long, a depth of 36%, and the handle 10%. So it seems to fit all of the categories and I guess the ranges that are most appropriate for a cup with handle.
Totally agree. Sometimes we do have bases that are deeper than 30 to 33%, we generally like to see that as the maximum decline, because when you fall only 25%, 20 or 30%, it doesn't take as much firepower to get that stock back near its highs and set up that launching pad for a breakout. So 36% admittedly is a little on the deeper side, but far better than seeing a stock that's fallen 40 to 50%. I find it interesting here too, Justin, on that weekly chart, that the relative strength rating, very solid, 94 over a 12-month period. Generally, my success with stocks generally comes among stocks that have a RS of 90 or higher. Plus, that relative strength line, that blue line, shows sharp outperformance versus the S&P 500 in recent weeks, and it looks like it is in fact almost hitting new high ground since the start of the formation of that base.
Yeah. Now, one of the things that's kind of interesting about this is this is a stock that was below its 40-week moving average line. We're looking at a weekly chart here. The 40-week moving average line is this black line, and it was below that for years, and then it just recently kind of got back above it, went below it during this base, and now here we are back above that 40-week line. Would you consider this almost like a bottoming base? I mean, certainly this one is, I think, a little bit more, the one back in 2020 was maybe a little bit more classic, but would you consider this kind of a bottoming base?
I would, especially given that, over a long chart that I'm looking at of the weekly, and you could easily see on a monthly chart that the stock had traded as high as 80 way back in 2015. And so it has been a long journey through the wilderness, if you will, in this company. And part of the reason is the fact that when I look at the fundamentals in Alkermes, I notice that the profit record has been spotty at times. A nice earnings per share in 1 year, and then a severe drop the next year, and then a rebound the next year, and then flat growth the next year. So that's typically not what we want to see in a true market leader. In 2022, in fact, the company is expected to actually post a net loss of 10 cents a share. So the fact that the stock is making a recovery amid an expected drop makes me more curious about what's going on with the company, and therefore I would highly suggest that people read more about what the business is all about now. And the sales growth could be a little bit better. You can see that the SMR rating is a C. That's generally not what I would hope for. However, 4 quarters in a row, double-digit growth, 23%, 11%, 16%, and 11%. Earnings growth in 4 of the past 5 quarters, and some of them were fantastic year-over-year increases. On the technical side, Justin, we have a up-down volume ratio of 1.4. What that means is that volume on the up days is 40% higher than overall volume on the down days in this stock over the past 50 sessions, or roughly 10 weeks. So an interesting mix here of technical strength, interesting fundamentals. I would like to see more funds that are top rated in this group, and I haven't had a chance to investigate that, but I do believe there are a few fund families that are invested in a decent way in ALKS.
In the medical area, AstraZeneca. Now, you mentioned, Moderna and BioNTech, and AstraZeneca was certainly on the cutting edge in terms of the vaccines. What is it about AstraZeneca, ticker symbol AZN, that caught your attention?
Well, first off, this breakout has been working from its own cup with handle at around 62.74, roughly $63 was the proper buy point, and the stock has gained not quite 20% yet, but at one point it looked like it was headed toward a 20% gain from that entry point. What I like about this one, Justin, is that unlike ALKS, a mid-cap company with about a $5 billion market cap, this is a mega cap in the healthcare field, $187 billion in market value, 2.8 billion shares in float. So it would take a tremendous amount of buying or selling to send this stock in either direction. So far, that direction's up. 92 relative strength rating. RS line is at new high ground according to the MarketSmith blue dot RS line screen. Company has really strong earnings growth estimates going forward, including a 34% increase for this year, $3.34 a share. That follows some acceleration in the quarterly earnings. For instance, in Q2 of 2021, earnings had fallen 7%, but then reversed to a 6% increase in Q3 and a 57% increase in profit for Q4 of last year. So alongside that, really, really nice accelerating revenue growth. The company continues to be a machine of innovation, over 100 different projects in the pipeline, including roughly 15 or so in late-stage clinical trials. And this company, Justin, gets its hands dirty in so many important fields of disease, whether it's oncology or immunology, metabolic disorders, rare diseases, cardiovascular. This is a major company to be watching.
And as you mentioned, because it has its fingers in a lot of different things, it's got a big pipeline, a lot of things in late stage that could potentially drive earnings higher. It's one of those things where you have to be very careful of those biotechs where it's kind of a one hit wonder, and you don't even know if it's a one hit yet. It's still in its trials and it's promising. You've maybe got a phase 3, but there's a lot of things that can happen in between your trials and your FDA approval and sales.
Oh, absolutely. So this company has been in the market for quite some time. I'm looking at a monthly chart, and at least according to MarketSmith, it goes all the way to 1993. It's taken a long time for the stock to make a 12-fold move, but here again, this is a large cap, mega cap company that hopefully will maintain support of that 10-week moving average. This is the first test of the 10-week line, following a breakout in a normal bull market. In good market conditions, we consider that to be a follow-on buy point. Obviously, with the market correction, there's a little more risk involved with buying, but I think it's just very interesting to see how this stock will do.
Well, and also, as you mentioned, there's this whole idea of relative strength where when the market is correcting, and it's languishing below its moving average lines, they're below the 200-day moving average line, below the 50-day line. When you see these stocks that are holding above the 10-week line, that should get your attention. When you see those relative strength lines that are increasing and getting higher, that's where we tend to gravitate when building our watch list. Again, not necessarily that we're going to buy right now because of the market conditions, but certainly that's where we fill our watch lists. Speaking of which, and since we are on the topic of A's, it seems like we might as well take a look at this little stock known as Apple, ticker symbol AAPL, that also begins with an A, outside of the medical area, but in telecom. What is it about Apple that you think might be worth watching here?
A lot of things here, Justin. First of all, we have earnings coming up tomorrow after the close. Such a bellwether, not only for the technology sector, but for the market in general. I had read somewhere, Justin, that as much as 15 to 16% of all the money used to buy back stock within the S&P 500 all comes from Apple. This is an amazing company, $2.5 trillion market cap. So that's almost, 12, 13 times the size of AstraZeneca. So we've gone from mid cap to large cap, or mega cap, to ultra mega cap. Monster cap. There you go.
It's always that first trillion that's the hardest. It seems like just yesterday that it hit that $1 trillion mark, but here we are now at 2.5.
That's right. And so if we look at that weekly chart, we can see on MarketSmith's pattern recognition technology that this is not an early stage base. As you can see, arguably a first stage base took place in the 2018 to 2019 period, and since then it's created a series of other bases. So clearly this is later stage, which increases risk that a future breakout could fail. Look at the earnings growth rates, they've certainly slowed down. And you could expect that given that earnings per share since the fourth quarter of calendar 2020 have gone up 34%, 119%, 100%, 70%, and 25% in the fourth quarter of 2021. So going forward, Justin, we have Apple facing some really, really tough year-over-year comparisons, or what like analysts on Wall Street like to call tough year-over-year comps. Sales growth has decelerated, maintaining a double-digit clip, but yeah, we've gone as high as 54% over the past 8 quarters, to down to 36%, 29%, and 11% increases. Even the number of funds surprisingly dropped a little bit. From the fourth quarter of 2021, we had 6,121 mutual funds own this stock. Now it's at 6,167, so a drop of roughly 54 funds. So that's a pinprick, really. I mean, it's not that's not like a major bloodletting in terms of the number of funds owning the stock. However, right now, as you know, Justin, we are at an important crossroads for this company. Can it maintain support at that rising 40-week moving average? Can it stay within this current base? Whither Apple goes, so does the market in large degree.
Yeah, absolutely. And we just had Microsoft earnings. That was one of the things that was maybe driving the indexes a little bit higher. We certainly saw that in the futures market. Didn't necessarily translate over into the next day. We had a lot of back and forth action in the indexes. So remember that this podcast will be dropping tomorrow. At the end of the day, you're going to have those Apple earnings, but just remember, either way, you don't necessarily you can't think that the index is going to do exactly what you think it might, just based on the earnings of one company. You can project, but just be ready to look at what actually happens.
Absolutely, and we'll also want to pay attention to any indications of inflation, the war in Ukraine, the Federal Reserve's stance going forward, because they're expected to raise rates pretty quickly in both May, June, and July. So it's certainly an interplay of many different elements.
But to that end, a lot of times there can be, these levels of uncertainty. As you mentioned at the outset, you can have a lot of bearishness, a lot of negativity and stuff like that. And sometimes that's when the market finds the gumption to turn itself around. So what would you suggest for people, listening today? What should they be doing in the next week or so?
Never take your eye off the market, for one. Watch for that first potential up day in the market, because every new uptrend starts with that first up day. We talk a lot about the follow-through analysis. I'm sure people listening in have read about that or heard about it across all our channels. And keep an eye on those stocks that seem to be defying any future declines. And that means looking at the stock vis-a-vis its action around moving averages, formation of good bases. Keep an eye out for any new changes in sector rotation too, right, Justin? We've seen a great rotation back into cyclical since the October-November 2020 period. Pretty soon it's going to be 2 years. I mean, in six months, who knows? Will those stocks continue to rally? Will there be other leading sectors as well?
Yeah, always keep an eye on that, because and that's where the relative strength line comes back in, just to kind of take it full circle. The relative strength will often cue you into, hey, where is that leadership now, especially those relative strength lines.
Finally, I would say that, just a real quick extra comment is that, on investors.com, we have an amazing stock research tables that are categorized by first leading sectors among 33 sectors. Who are the leading sectors? And then the stocks in those sectors are alphabetized A to Z. Right now, there's a lot of defensiveness within the leading sectors, whether it's utilities, We have obviously cyclicals, energy, but we don't see that many growth sectors at the very top. Watch for any potential change there.
Good advice. Well, thank you again, David, for coming on. And as you mentioned, people can follow you on Twitter at IBD_D Chung, and also at your other one that has a little bit more flavor at Saito-Chung. Two places to follow you and get more information. And of course, you do a lot of writing in the paper. So whether it's the big picture, all sorts of things, you'll just type in David's name and you're going to find him all over in terms of articles, or his very nice editing jobs that he does on a lot of the articles that you see. So you might not see his name on it, but his fingers are in there. So thank you very much for being on the show, David.
Hey, Justin, it was a blast. Thanks for having me. It was really a lot of fun.
Absolutely. Okay, and next week, Arusha Paris will be back, and we will also have, most likely, a guest. We will stay tuned for that. So thanks for watching this week, and we will see you next time. Take care. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.